Hey everybody, let me ask you, are you tired of always losing on your option trades and you see all these people online always posting consistent profits? Well, that's because they understand the game, all right? When it comes to the world of options, it's all about statistical advantage. And if you stick with me over the next couple of minutes, I'm going to show you how you as a new trader can actually give yourself the highest statistical probability to be right on your trading and give yourself a trading edge that can change your life. So let's go ahead and get into this, and I'm going to go ahead and get started with what we're going to talk about, which is actual trading option spreads. So, what an option spread is, it's a trading strategy that actually involves buying a leg and selling a leg on an option contract. What I mean by that, if we go to Tasty Works right here, and I want to go to something called long calls, I'm going to click go, and it will show you that you're going to buy the call, and you're also going to sell another call. So what happens is it actually gives you a reduced risk on your trade. What do I mean by that? If you go here, when you go to execute the trade, it'll show you this case, you have a maximum profit of 236 and a maximum loss of 264. To where if we were to do the same thing, which is a 403 call, let's actually go to just do an option call instead. Let's see, that's 405, let's do the 403. Now we actually have an infinite amount of profit, but we have a max loss of $640. So here's where people tend to get a little mixed up. Nothing in the stock market ever actually quintuples in value consistently. People try to buy these YOLO contracts and they always get burnt doing that. They're not giving themselves a conservative statistical advantage to make sure that they are getting in at the right time for their trade and actually taking profit when it's time to take profit. So let me go back to the spread for a little bit and really go and explain what's going on here. Oh, wrong one. There we go. Ain't nobody's perfect, right? All right, so if you're bullish on a stock, you can buy a long call spread. And what that means is you're going to buy one call, whatever call you like, whether it's out the money or in the money. If you're a little more conservative, it'll be in the money. And then you sell another call either out the money or in the money. If both of these contracts are in the money, that means you're extremely conservative, which gives you a higher probability of success. However, you're going to have more money for this trade. What I mean, in this situation right here, our maximum profit is $165. Our maximum loss is $335. All right, but our probability of profit is 57%. But let's do the actual opposite. Let's say we buy a call that's out the money and we sell a call that's even farther out the money. Say right there. Now our probability of profit is only 39%. But if you look here, our maximum loss is drastically reduced, and our maximum profit actually increases to where we can risk less money to make more profit. That right there will ruin you as a trader, trying to risk less money to make more profit. In the world of options, it's backwards. If you want to give yourself a statistical edge, first, you want to always sell in the money, and you always want to buy deeper in the money. So in this case, the best trade right here would be having a max loss of 431 and a maximum profit of 169. Because here's the thing, guys. When you're in this trade, you don't have to risk $431. If you're down 10% on your 169, which would be $16.90, you can get out. You don't have to hold it through there. If it's going the way you don't want it to go, you can get out at any time. But you can always give yourself a higher probability of success just by having the right strike placement. But guys, if you want to give yourself an even better edge, I'm about to show you the magical tool that most traders who are successful utilize. And that's actually selling spreads. So when we sell a spread, we can still be bullish when we sell contracts. In this case, we're actually going to sell puts. So stick with me on this. The logic is, if I want to buy a call on a stock, I will also sell a put when needed. What does that mean? That means selling puts is the equivalent of actually buying calls on a stock. So if I'm bullish, I'm going to go short puts, and it's the same setup. The sell leg, you want as close to the strike or wherever you want it to have, depending on your strategy. Then this green leg right here, the one you're buying, you want it to be deeper. That way, this width difference comes as profit to you. So the con to this, it does take a little more upfront to utilize. So you have to have at least $751 for this trade to go through. However, your probability of profit is 67%, and it's actually even higher because we're factoring something different. We're capitalizing on gaining theta. So what do I mean by that? Every day you hold an option contract, a naked contract, right, you're actually losing value on that contract, whether the stock goes up, down, or stays the same. So every time you have to hold that contract, it's slowly losing value. So besides it slowly losing value, and you have to be right on the direction, Why don't we sell contracts where we actually get to collect that theta? That way now, not only can we be right on the trade, but we can also get paid to hold this position. What do I mean by that? That means as long as I think the S&P 500 will stay above $400 the next 14 days, I will make $249. But if it goes up, down, maybe it goes up a little bit, then it pulls back down, and it goes down to like $400, on the long side, I would only be able to capitalize a fraction of that. So let's go to the long call. What I mean by that. We go to the long call here. I think it was like the 390 and the 400. I actually think it was a little bit closer. We'll run this again just to be safe. But basically what happens here is if this stock goes up, then it pulls back, I'm going to lose value. But on the put side, if this stock goes up and comes back, well, I am going to always collect that theta and always collect a return no matter what happens to the stock here. I just think it's going to stay above this line right here, which is your break-even price. Yep, my break-even is 397. So as long as this stock stays above 397.64, I'm golden. So now let's add one more step to this. I actually have the S&P 500 pulled up here. So for all my technical analysis guys, you can see we bounce hard off this long-term trend line right here. So I feel confident knowing that the S&P 500 will stay above roughly 392 for a couple of days. So what can I do with that? I can set up my spread to say 392 right here. So if I want to sell the call right here, I have two options. I can either sell the call that's 392, so let me move this back a little bit, or I could set up a system to where my break-even price is close to 392. That might mean I can buy a put that's a little bit higher up, right? So in this case, that one's 392.75, so that'd be a good example if I want to reduce my risk. Bring this up. So now my break-even is 393.42. My maximum loss is 242. My maximum profit's 58. Some people might look at this and say, oh, no, you can't risk $242 to only make 58. Well, guys, the only time that would actually happen is if the stock plummeted overnight. Will that happen? It possibly could. But that's just as likely as YOLOing and winning on an option contract. Now you see where I'm getting at here. All right. So besides playing the slots, the casino, and buying YOLO option contracts, by selling these contracts, we actually become the casino and give ourselves a statistical edge that this will execute appropriately. So when you combine spreads with technical analysis, you really can give yourself a trading edge and become more consistent and more profitable. And guys, if this is too expensive for you right here, you can always get a longer DTE. So if you want to do 28 days till expiration, now you have a max loss of 232 with a maximum profit of 68. Utilize your technical analysis, guys. Like I said, we hit a major support line on the daily chart here, so it's likely to stay above this price for a while. So you can comfortably sell a put at 392 and collect that theta and be right on the direction for however long you want. Because if this stock keeps going and goes up to 420, and you're only 5 days into your contract, you still get the benefit of buying a call, because as that price gets farther away, no matter how quickly it gets away, as long as it still goes this direction, you still get to profit on the decreased value of the put that you sold. Because remember, we sold the put for a high value. We want to buy it back at a low value. So we want the stock to move this way. But even if it doesn't move this way, we can still collect on that theta. There's one more thing I want to show you guys just so we're here. Y'all checked out other stuff on the channel already. We actually have a cool tool known as TradeUI. TradeUI is an option flow filtering system that gives yourself a trading edge. Give me 2 seconds, I'll pull it up here for you. Should have had it already pulled up. So TradeUI is an awesome tool. This gives yourself a trading edge, because what happens is it'll actually show you, there it is. It'll actually show you all the option, there it is. It'll actually show you all the option flow data that comes in through the day, so you can utilize this to give yourself a trading edge. You can also implement this into your trading strategies to see how it benefits you as a trader. They have a lot of cool tools. We have a lot of stuff on the YouTube channel already that shows you how you can use TradeUI and combine it with everything that you've learned already. However, guys, at the end of the day, this is supposed to be an educational video for how to use option spreads. I hope y'all enjoyed the video. If you want to check out TradeUI, I'm going to drop a link in the description below with a discount code. And we also have a free trial you can utilize. So check it out, see if it's for you. Guys, I hope this video helped you, and I wish you become a better trader with all of us. Peace out.